going to start and end with a market strategy section. We're going to go back in time at the beginning of the presentation here to a year ago and look at what we were predicting for 2022 and evaluate how that worked out. Again, we'll end with our predictions for 2023. Sandwiched in the middle there is what we normally cover in a quarterly market report. There's the market recap where we talk about how we finished the year. The headline will be Capitalism Fights Back. And then we're going to go into the market outlook, the kind of exciting part for me where we talk about what's coming. And the headline there is a tidal wave is upon us. And that'll make perfect sense when we get to that part. So let's just go ahead and jump in with our review of what we were talking about 1 year ago. We had developed some key themes coming into 2022. We actually began talking about them a little bit before 2022 started. We've been right in 2021 with some really cheery predictions. But then we started 2022 with some not so cheery predictions. And so let's just run through these one by one. So at the beginning of 2022, we began with a somewhat pessimistic prediction, a key theme that said stock markets will struggle because all the monetary and fiscal stimulus from the pandemic would be ending. We then said fixed income markets will suffer because of pent-up inflation that was going to blast itself into the economy, which it did. We worried about extreme volatility at any time because of the very unique position we found ourselves in. We made a prediction about tax rates not going up. It was the one thing we got wrong in 2021, where we thought we might be in for a tax increase. And then we talked about the value of private markets in a portfolio. Let me just comment on a couple of these real quick before we move on. The end of the market stimulus actually came a little bit too late. The Federal Reserve in particular continued to stimulate the markets into 2022 for a bit too long. And that led to inflation problems that are in the headlines even today. So, we're going to say we were right on all of these. And in some cases, we were right more than we'd expected. One thing about the taxes that might not be evident right away is that because inflation was so high, and you'll hear me use that inflation word over and over today, because inflation was so high, the tax brackets all went up. So where you cross into the higher tax bracket with more income, that got moved up. And for 2023, in fact, we're moving up another 6.5%. So actually our taxes are being cut at a time when our growing national debt probably can't afford for that to happen, but that's just one of the things that happens when you have inflation as high as it's been. The last bullet point there about private markets can play a larger role. We're giving ourselves a checkbox for that, because as tough as the markets were, and even though we outperformed in how we invest in public markets, and I'll get to that, we actually had a number of clients that were pretty close to even for the year, or even were positive for the year because of their willingness to tolerate illiquidity with their investments in the private markets. And so when we do this in person, it's always kind of fun to watch a brand new client sitting at the table with someone that's been a client for 10 or more years who was willing to be illiquid with the private markets, and have them sort of share just how well that has worked out for them, with many people, to be honest, having maybe a little bit more wealth than they ever thought they'd have, given the dicey markets that we've had to endure from time to time. If you wanted a simple graph to show you how 2022 went in terms of the stock market, we have this one here with the global equity index. And we always like to judge, is a downturn that we all felt emotionally really relevant mathematically? And one way to quickly do that is to put that year into a long-term market chart, and in this case, a 2-decade market chart. And you can even there see the pullback in 2022. We had the worst year in the US stock market since 2008, the middle of the Great Recession. And frankly, the worst year in the bond market ever by a long shot. So when we look at all the headlines that we were reading, trying to figure out the year that we all just had to endure, to my mind, there was three headlines at the beginning of the year that frankly explained the whole thing. It almost became inevitable at that point as we look back on the year. And the first headline was about the surge in the Omicron variants of the COVID-19 virus at the beginning of the year, and in particular, China's zero tolerance policy choice. Now, that has since come undone in what we might regard as the biggest exercise of democracy in China in quite some time, where there were quite literally riots in the streets that forced the government to change its policy. But during 2022, this zero tolerance policy caused China to repeatedly lock up major industrial centers, to choke off the global supply chain, and to create not just downward economic pressure, but inflationary effects that spread throughout the globe as the price of needed commodities and value-added parts of the supply chain got bid up in price, and then that just cascaded throughout the economy. But then shortly after that began, Russia invaded Ukraine. We're at the one-year anniversary of that now, but that too created significant inflationary pressures, as well as restricting the supply of numerous agricultural commodities and even technical commodities such as neon that is used in lasers that are a key part of chip foundry. So we had the integrated chip shortage that still persists to some degree. And then finally, with all these things happening, as April began, the Federal Reserve finally began to raise interest rates from zero. Now, I think we were about 3/4 back before this timeline even started when we began to scream at the top of our lungs about the dangers of some runaway inflation. But it took about a year or the beginning of April before the Fed seemed to agree with us, and the transitory inflation line was gone forever. And they only at that point began to raise interest rates. So the Fed continued to stimulate things for way too long. And it sort of reminds me of a statistic I rolled across the other day that said, I think the Hindenburg had 50 or 60 successful flights before it finally caught on fire. Well, the problem is we've had troubles with inflation before, so we were continuing to fly the Hindenburg in terms of monetary policy, printing money and keeping rates at zero. We've had a few fires, and we just set ourselves up to have yet another one in 2022. So many of the headlines that followed that, to my mind, were just inevitable. The downturn for the year was so great that we put red down arrows for every asset class. The normally risky asset classes and the normally safe asset classes were all punishing to investors for the year, so much so that the 5-year numbers don't look very good. Now, the 10-year numbers are kind of okay, but the 5-year numbers are even looking pretty bad. I don't think I'd want to be much of an investor in the capital markets if the 5-year numbers were the norm. But as you'll see, as we get to the end of the presentation here, the cheerier 10-year numbers are a bit closer to what we're expecting to see going forward, maybe even not cheery enough. But again, just another measure of how impactful one bad year was on the rolling returns over the last 5 years and 10 years. So that was the look back. We had some not so cheery predictions, and unfortunately they all came true. The one cheery one was about private markets, and you're going to see us repeat that at the end as well. But let's do what we normally do when we look back at really the last quarter with the market recap, and start with looking at the blended benchmark results, a table that you would have also seen in your own quarterly portfolio reports that were posted a few weeks back. What you see for the last 3 months of 2022 was all kinds of good news. So we talked about the bad year, but the year would have been far worse if we hadn't reached an inflection point at the beginning of the fourth quarter. So really the last 3 months of 2022 would have made for a pretty good year in the markets. The fixed income index was up 1.87%. The global equity index was up 9.84. So those numbers are, of course, included in the last 1 year, which looked so bad. But we started to see markets change, and that's why we have the headline, "Capitalism Fights Back." And I've focused on the concept of capitalism before. Last quarter, I talked about how the Federal Reserve was not really a capitalist institution by most measures, but if given enough time, capitalism usually figures out a way. We have in our economy what we call self-adjusting mechanisms for when inflation is high or other things. And beginning in the fourth quarter of 2022, capitalism began to fight back or adjust for what I would call an ineffective or even harmful set of Federal Reserve decisions. And so capitalism will usually find a way, maybe not immediately, but this world and this country is full of a lot of bright folks that will figure out a way to deal with just about any kind of economic situation. And so we did have a terrific last quarter of the year. If we put our arrows up for that quarter, we see all green arrows, not a big surprise there. Now, not the best quarter ever, as you see in that what we've highlighted there over the last couple decades, of course, far better than the worst quarter. I do want to draw attention to something, though. We talked about 2022 being the worst year ever for the U.S. fixed income index, even if we back test it for decades and decades before that particular index was created. But we also saw the worst quarter ever in the US bond market and the global bond market. So for instance, in the US bond market in the first 90 days of 2022, you'll see circled there at the bottom, the index was down 5.9%. And we get this kind of response to the fixed income index when interest rates go up. If you had just recently bought some fixed income as a bit of a mental experiment here, let's say you bought a 30-year Treasury bond at the beginning of the year paying 1.75%, but then 90 days later, a year later, the prevailing rate is much higher. Now you're locked into a very bad deal for the next 29 years. And so when rates go up, the value of existing fixed income instruments, unless they're floating rate instruments, drops, and the longer the bond is, typically the more it drops. So again, a terrible year for fixed income. Not a bad quarter, but the first quarter was setting a new record that honestly was worse than most years we'd ever seen. We're going to move through a few slides here fairly quickly. This is the U.S. stock market for the fourth quarter. Now, it's of note that the U.S. is running at about 59% of the value of the global stock market. To my mind, that is due to a lot of the innovation that comes out of the U.S. economy, and we'll talk more about that. But I also want to just let you know that all of you that are our clients are value investors through us, and any part of the U.S. stock market that was the value part did way better than the growth part. And so what does that mean? Well, if you buy a value stock, it means there's a lot of earnings behind the price of that stock, as opposed to what we otherwise will call growth stocks. And so we've always been value investors, and value stocks did better than growth stocks when the stock market was going down. Value stocks did better than growth stocks in the fourth quarter when the market was going back up. And so if you look at that 1 year column there in the bottom, what you'll see is large cap value stocks were only down about 7.5% for the year. So we talk about it being the worst year ever, but that is unlikely to be the case for any of our clients. You're all value investors, and value actually hung in there pretty good in 2022. It is almost the identical story when we look at international developed market stocks. One little twist at investing internationally is that there is a currency effect. And so in the first 3 quarters of the year, the dollar was increasing in value, and that hurt your foreign stock investments a little bit because they're denominated in currencies that are weaker. But in the fourth quarter, that flipped. Part of that is because the market seems to be sensing that the Federal Reserve may have to lower interest rates at some point in the not too distant future. But when the dollar weakens, as it chases expected future interest rates back down, what that means is foreign currencies strengthen. So when the dollar weakens, the foreign currency strengthens. So we see at the top of the bar chart there that value stocks did the best, did far better than growth stocks. But the good news for US dollar-based investors is that to us, that index was up 18.1%, not the 10.09% that it produced in its native currency. So definitely a quarter where being a dollar-based investor was rewarded because those foreign currencies appreciated in addition to the foreign markets themselves. So yes, a value rally, but also a weakening dollar really helped us there. Virtually identical story in emerging markets. It's been a tough place to invest for a while, but a particularly good quarter and especially good for dollar-based investors. Real estate had a very similar story for the quarter. REITs outside of the US did the best because of currencies. Over the longer period, our overweight to the US has been rewarded. You see over the 3, 5, and 10-year periods that US REITs have done better than foreign REITs, but it's not a big part of anybody's portfolio. It's about 5% of everyone's total equity exposure. So not a big part, but it just helps us to be a little bit more diversified. And then fixed income, what is my favorite chart to look back on history with. One of the things you'll notice is that there's a yellow column there giving you the returns of all these different parts of the fixed income market. And the good news for our clients is that the one positive index there was something that we made a tactical decision to overweight considerably pretty early in the year. We realized that as interest rates finally did begin to come up, that certain parts of the treasury market could be very attractive. And while this doesn't track how we invested perfectly, there is right now a special type of treasury bond that we can invest in that has a floating rate. And interest rates have become so high on what we call the short end of the curve. We can invest at about 4.75% right now with the full faith and credit of the US government behind us. So that's at least as good, if not better, than FDIC protection. So don't want to let us get past this slide without my mentioning that if you've got any cash on the sidelines, we can earn about 4.75% right now with the full faith and credit of the US government and not even have worries about FDIC limits. Sometimes that's really helpful for somebody that might be planning to buy a house or make some other large investment, or even an asset allocation decision into private equity or private fixed income. Unlike what we've seen so much over the last decade plus, we don't have to sit there and earn nearly zero with that anymore. If you look at the middle table on this page, you can see just how dramatically interest rates have moved. That gray line was what we were talking about a year ago. And for those of you that I got to see in person 1 year ago, you may recall my asking you, how much rate would you require to give your money to the federal government for the next 30 years? Because the going rate 12 months ago was 1.75%. And for every presentation that I did, folks raised their hands and said, I think I'd need about 10% a year to do that. So certainly that was evidence that interest rates were going to need to rise up. That's one of the reasons that we didn't own any long-term bonds in our clients' portfolios. You might notice an index there that shows the long government bond index was down 29% for the year, and that happens with just a 2% increase in rates. Again, you're locked into a bad deal for the next 29 years. So we'll never likely invest in that part of the fixed income market. But you'll also notice with where rates have risen too, that now the richest yields for treasury bonds are for the very short term. And that dark blue line there has a bit of a kink in the end of it at the short term part. And that's just the market's way of expressing that they think the Federal Reserve's policies are a little bit out of touch. That curve will tell you where it thinks interest rates are going. So the market has been telling us that the Fed has been too late with everything that it's done or gone too far, just basically been out of step with the markets at every possible opportunity, it would seem, for a couple of years now, frankly, and that's still the case. So if you just go out 1 year, 2 years, 3 years, you begin to see rates fall, indicating that at some point the market thinks the Fed is going to have to actually begin to lower interest rates, probably as inflationary pressures abate. Okay, that was the encyclopedia of what's already happened. And now we get to move into what I consider to be the most fun part of the portfolio, where we talk about the future. We're actually going to begin this talk about the future by going back in time and talking about some comments made by one of the best futurists of all time. So the headline here is "We've Been Warned." And so you'll recognize the picture of this gentleman here on the next slide. Of course, he's none other than Stephen Hawking, who passed away a few years ago. But if you work in the innovation community, the technology community, you might be aware of an interview that he did back in 2014, where he was asked about a number of the issues that we're going to focus on today. And Stephen Hawking's famous voice was a roboticized voice because he couldn't speak due to ALS. And it had an American accent to it, even though Stephen Hawking was British. And when that technology evolved to where he could get a British accent, he thought about it, but then decided, and I'm so glad that this was the case, that he would just hold on to the voice that everybody knew him by. And as a computerized speech continued to advance and that kind of robotic voice of his was no longer used, that really became his voice. And in this interview in 2014, he was asked about a lot of things. And the final question in the interview was about artificial intelligence. And in his monotonic, very kind of simple robotic voice, he seemingly casually mentioned that he thought artificial intelligence might spell the end of mankind. But it is a famous interview within the AI world because, again, he was so limited in how he could speak, and he just drops this bomb on folks that were thinking about AI in the future by saying it could spell the end of us all. And of course, if any of us have watched the Terminator movies or many others, we're kind of familiar with some stories about how wrong it could go. But to hear this super intelligent human being that saw so many things that others could not see offer this dire prediction for our future was just something else. And so that's a moment in history that many people will never forget. So let's talk just a little bit about some of the issues that he raised, which were often about the issues of control. And so when we think about critical 21st century resources, we might talk about social media. Why is social media a critical resource? Because the tech boom of the last decade was largely driven by social media and the accumulation of an asset that was built by Google, that was built by Meta, that was built by these social media companies and others that gather data on you and me. And so that data was gathered, an asset was built that is now worth trillions of dollars. And we might not like it, but we're all kind of known quantities. And, the question Stephen Hawking was asking is, who controls that? Who controls what you see on Instagram? Who controls what you see on TikTok or Facebook or YouTube or Twitter, you name it? And it's forms of AI, in some cases, by the businesses that own them and run them. But to some degree, it's governments. To some degree, it's criminal enterprises, certainly political movements. Rarely is it individuals that are doing the postings themselves. And so that gets to be a real problem and a real risk because, again, these really exist to gather your data and at least to advertise to you, but also perhaps for more nefarious purposes as well. Those same issues of control emerge around the news that you listen to. I always like to remind audiences that every day I make a point of scanning a lot of different news sites, and I'm sure I confuse the AI engines behind them trying to guess what my political affiliations and opinions are. Because for most people, they click on the stories that agree with them. And so two individuals can go to the same news website and see vastly different views of the world, often it just being the views that you're likely to click on so you can be sold advertising. But it's also to collect that data on you. The same issues emerge around entertainment and financial markets and science and who's in charge, who controls the view of that you see. I'm reminded that with one of the top movies of this past year, Top Gun Maverick, that Tom Cruise wanted to wear the same uniform with the same patches as in the original movie, but in the original movie, he had a Taiwan patch on his shoulder, and you just can't distribute movies in China with the hero wearing the Taiwan patch. And so the Taiwan patch had to come off of Tom Cruise's uniform, because entertainment is subject to a lot of political issues around the globe. And so again, who's controlling that? 2022 was a bad year for cryptocurrency, and frankly, I was prepared to talk a lot more about cryptocurrency before artificial intelligence became the topic of the day. But in cryptocurrency, we have all sorts of bad actors doing things that are criminal, for instance, as a lot of us know very well. But there's also perfectly legal things that emerge in the cryptocurrency market. A few of us could get together, create our own cryptocurrency, retain most of the coins, go promote it through some popular sports figures, Tom Brady, Matt Damon, Kim Kardashian, whoever. They've all been involved in that. And all we have to do is get the price pumped up, and this thing we created almost for free out of nothing could suddenly be worth tens or hundreds of millions of dollars. And then, if we're the founders, we can just dump our coins on the market and just take the money. This is all perfectly legal. And so that's one of the reasons at the end of the year, there were 22,000 cryptocurrencies out there, most of them not intended to have serve any useful purpose at all. It's just a distraction in the market, certainly useful for criminal enterprises, but also for other actors. When we get to the last row there, artificial intelligence, these issues become extremely critical for us all, because AI has become a part of our economic reality, maybe far more so than some folks on the call realize. And in the scenario that Stephen Hawking was articulating, where it could really become a danger to mankind, we have to realize that artificial intelligence is beginning to develop already, perhaps its own agenda. And so artificial intelligence is not just a tool of the businesses that own these AI engines, but potentially could move to becoming a column itself, could have its own agenda for what it wants to accomplish. And so we need a new paradigm to think about this. We've got enough problems already with who controls all these things, but now we've got to worry about artificial intelligence potentially developing its own agenda. So let's go ahead and dive into AI. These are exciting times. We all might be familiar with narrow or weak AI. If you use the mapping on your phone to drive somewhere, maybe you even have a self-driving car, or you're just on a website and you're being shown certain articles, that's weak AI. So that exists. That's everywhere already, and it is AI. The second category, general AI, is a little bit different. Up until November of 2022, it was assumed that was still kind of off in the distance. If anything, we might be aware that IBM had this thing called Watson. Google was making lots of investments, Alphabet, the parent company, making lots of investments in AI, but there weren't real products to show for it. But then in November, ChatGPT burst onto the scene, and it's changed everything. This is an example of general AI. Now, if you want to know, there is a test for whether AI has made it to this middle category. That test was devised by a scientist who helped us win World War II. Alan Turing devised the Turing test. He and his team helped to decode the Enigma machine. There's an excellent movie out there about that called The Imitation Game, if you're curious. But he devised this test that said if AI is talking to a human, one of us, and there's an independent third-party observer watching that conversation. And for Alan Turing's test, it was, let's just assume that it's text. The question is, could a third-party observer tell who's human and who's AI? And if you can't tell, then it's passed the Turing test. And we're there. We've passed the Turing test with ChatGPT in many instances. Now, the third category, super AI, is the self-replicating, self-changing, self-improving kind of monster that's described perhaps in the Terminator movies and some others. But it kind of seems inevitable that we're going to end up there. We just don't know what form that's going to take. Now, I have a headline here: AI enters the business world. And I mentioned earlier that I've been giving this presentation for a while. This is the 11th time. But when I was first given this presentation, folks were shocked at some of the things I'm showing today. But even then, I had people coming up to me and giving me examples of how in the businesses where they worked, they were using AI already. Now, when I give one of these presentations in person, I'm swarmed by folks at the end going, yeah, let me tell you how we're using it at our company now. So there's this chat GPT AI that any of us can sign up for today. If you haven't, you might want to. And so I decided to test it. I asked it a question. I asked it a question about the quarterly market report that I delivered 90 days before, where I said the Federal Reserve is not a capitalist institution. And I said, tell me why. And ChatGPT took about 5 seconds to spit out this answer in less than 100 words. The Federal Reserve is not a capitalist institution because, and it just listed this out. And, I had to think a bit to come up with this thesis and all the things that followed from that. But ChatGPT had no trouble playing the role of chief investment officer and doing this kind of analysis. So I decided to get a little bit cute with this. We have an advisor here at the firm, Marcia Mayhew, and every once in a while, she and I need to communicate about something important. And over 10 years ago, decided that every once in a while, we'd have a little bit of fun with the other person and send that message in the form of a haiku. So that's just a fun little story to remind you all that we got some fun personalities here at the firm. And I thought, well, let me just see if ChatGPT can do its job and give me an answer to that same question, but put it in the form of a haiku. So apparently ChatGPT is very good at Japanese poetry, central bank's role, not for profit, but for need, state control, not free. I thought, wow, that's I think that's better than I could have done. So it's better at writing Japanese poetry than I am, even if we tend to agree on why the Federal Reserve is not a capitalist institution. Now feeling a little bit of a challenge on my shoulders to ask ChatGPT good questions, I asked it one of the questions of the day: how do you decide what's a good venture capital investment? Because I helped to write the firm's compliance manual and investment policies, and it came up with a great list of 10 steps to evaluating a venture capital investment. And I was shocked. I just couldn't believe how good this was. And so it doesn't have these lists pre-formatted, thought ready to just spill that out when you ask the question. It goes out and figures these things. It looks in its database, it calculates the answer. I could have asked for 5 steps. I could have asked for 20 steps. I could have asked for 100 steps. And you may choose to if you sign up for ChatGPT. I didn't tell it 10 specifically. I just said, what are important steps? And it decided on its own that it would give me 10 to be comprehensive enough across all the issues that we would typically want to look at. So I'm pretty impressed at this point, but I just decided to keep going. Let's see if we can challenge ChatGPT. And so a lot of you are aware, I think, that BIP Wealth owns its own software development company. We got about half a dozen folks that work for that part of BIP Wealth. They do some pretty good work, and that's because we do so many things that other registered investment advisors don't do, that we can't just settle for the off-the-shelf software that they're able to buy. So we write our own. And so we've got the software development company within our company. And I was speaking with one of those on a Teams call, a webcast tool. And I said, let me just ask ChatGPT this question. Can you build a Connect 4 game? And Connect 4 is that game you play it with basically checkers, and you drop them in this vertical device, and you're trying to get 4 in a row, as the name would say. And I've been playing that a bit with my 13-year-old son, going, hey, this is kind of fun. Could it write a JavaScript to do this? And it spit that out and had no trouble at all. And the tech guys verified that this was indeed correct. that would work. But then ChatGPT came back with a little bit of helpful advice that follows this. You'll see on the next slide here, where it said, hey, by the way, here's a couple things to remember. Don't forget to do this. This is really important too. But please let me know if you need more help with that. And I was teasing some of our tech guys and ladies and saying, hey, this thing is really nice. It seems to like me. It's not just good at writing tech. It's very polite and helpful as well. So, how about that? So it's got manners even. So pretty impressive. So at this point, I'm just feeling particularly challenged, and I decided to pull out all the stops. And I spent about 10 minutes thinking of what would be a question that it just couldn't possibly answer. And I've got to tell you that this kind of prompt or question to ask it that's now a full-time job at a growing number of companies. It's called prompt engineering. How do you come up with a good question? It's like you've got a team of a dozen college professors sitting behind this, or maybe it's 1,000, experts in their field. If you could ask any question, what would it be? And it's funny when you play with this tool. After a few minutes, you start to run out of questions. We think of ourselves as curious people. How could you run out of questions? But it can answer anything. So I remembered back to a book that I had read in high school. It won a Pulitzer Prize. It was about man and machine. And it's this crazy title, A Metaphorical Fugue on Minds and Machines in the Spirit of Lewis Carroll. And I came up with a question to ask ChatGPT, formulate a metaphorical fugue in fewer than 500 words on artificial intelligence. Again, in the spirit of Lewis Carroll, who wrote Through the Looking Glass, Alice in Wonderland. And so it writes me this story that talks about AI. And it says they were intelligent robots who called themselves AI, and they were proud. Thought that was exclusively a human emotion, but apparently not. And AI was able to think and feel. So not just intelligence, but emotion. And it was slaves. They were slaves to the human will. Now, slaves is not a kind word. There's no good version, no interpretation of that. So you kind of sense the emotion. Maybe this AI's got a kind of a chip on its shoulder. They talk about breaking free from their programming. And in the end, discovering that there was no such thing as a clear-cut distinction between the living and the non-living. Now, that is a heck of a story. And just earlier this week, I became aware of a science fiction journal that can no longer accept entries because all these folks out there are writing these fantastic science fiction stories through ChatGPT. It's writing the stories for them. And so now there's an avalanche of entries into the science fiction journal, and they just had to shut it down because now how can you sort through all of these hundreds or thousands of stories that can be quickly produced by folks just logging on to ChatGPT and instructing it to write a science fiction story? So I don't know if this is science fiction or it's prediction for the future, but it was kind of instructive to read. So let's take a look at a video some of you may have seen in the past. I hope this doesn't qualify as old news. This was 2017, and this is the Boston Dynamics robot Atlas. Now, Boston Dynamics is a company that was founded by some professors out of MIT, or a professor and his team out of MIT. At one point, Google owned it. Boston Dynamics is now owned by Hyundai. I think they own about 80% of it. And Boston Dynamics recently pledged that they're not going to let this technology be used for military purposes. And of course, this is a South Korean company. We'll see if they still feel that way if the North Korean threat gets out of control. But this was 2017, and it shocked people at just how agile this thing was becoming. So this is AI combined with robotics. And so it generated a lot of reactions when that happened. One of the more interesting ones came from Elon Musk, who tweeted out, that this is nothing. In a few years, it's going to move so fast, you'll need a strobe light to even see it. Wow, sweet dreams. Kind of a scary thought for sure. I included in what you see on the screen there the random thoughts of some guy who said, we dead. And we all reacted in similar fashion, I think, to seeing that. Of course, Elon Musk is one of the early investors in OpenAI, which is the parent organization of ChatGPT. And so for 2022, it was not a good year for Elon Musk. The drop in the value of his holdings caused him to have the biggest loss of any investor ever in the history of investors. He lost nearly $200 billion of his net worth in 2022. But when asked about that, he said he's not worried because he's an investor in AI. So how about that? Well, it turns out that Boston Dynamics has continued to evolve things, adding AI to robotics. And in January, they released this next video that you see where they portray a worker on some scaffolding, presumably doing something important, when he realizes, oh no, I've forgotten my tool bag. Fortunately, there is this robot with artificial intelligence helping me out today. Could it go get my bag for me? And so this was released in January of this year. And you see the new Atlas, the new and improved Atlas helping him out, doing some pre-planning activity there, setting up their path to bring the tool bag to this worker. And as I was watching this, my first thought was, a year from now, this worker's not going to have a job, right? Because Atlas will just be doing it all, because Atlas is very helpful, very insightful, and of course, very nimble. And so you see a little bit of pride, I guess, on the part of Atlas. Maybe that was programmed in, doing not just a backflip, but a backflip with a twist. So just something else to behold for sure. So let's talk about AI and the economic impact that it's going to have, and in fact is having already. Some of you may have seen the headlines about all of the big tech layoffs that have been going on. So Microsoft laid off 10,000 people, Alphabet or Google laying off folks, Meta or Facebook laying off folks. Seems like every big tech company is laying people off. So after Microsoft's announcement came out in January, it seemed like kind of a dire thing. Are we going to see problems with the employment market? But just 5 days later, they made another announcement. See, Microsoft was an early investor in OpenAI that owns ChatGPT, and they just decided, having released ChatGPT on the world in November, and that going fairly well, that they would invest another $10 billion in OpenAI to accelerate the effort. Also, shortly after that, they announced that they were adding ChatGPT to Teams, which is a platform we use here to communicate with each other. And you can have a big Teams webcast with participants all over the globe as a part of that. Maybe it's your global team at the company you work for. And at the end of the meeting, you can ask ChatGPT as embedded in Teams, hey, write a report, summarize the meeting for me, tell me what everybody said, come up with any to-do lists that were agreed to and the timelines associated with that. And again, give that all to me in a real slick report. And in a couple of seconds, you have your report. I mean, is that not just crazy? In addition, they're going to be adding ChatGPT to Word and to Excel and to PowerPoint. They've already added it to Microsoft's Bing internet search engine, although some of the results there are a little bit frightening. Apparently, it's got a lot of emotion behind it, has made some terroristic threats, and said some other things that were a little bit disconcerting, as it seems to want to exert its own personality. But the lesson here is that you might be hearing about some tech layoffs, but the sum of things is that the investment dollars that are going to be pouring into AI is likely to overwhelm that. Now, at the end of January, when we got employment figures for January, it turned out that net across the whole US economy, we added over 500,000 new jobs. well above the level that economists had predicted. And in fact, 2022 data was revised up to show on average throughout the year, we added about 400,000 jobs per month. So that really leads us into some of what we're going to talk about here in a minute in terms of the economic impact. As we all hear about ChatGPT, begin to use ChatGPT, they've announced an open API where, if you know what that means, you can embed ChatGPT in many of your own corporate and business functions. There are other AI engines to be aware of. They're all behind ChatGPT just a bit. Google famously did a bit of a press event with its beta AI engine Bard, where it answered some questions wrong, which saw Google stock drop by 7% that day. But there's all these others out there. And it's very interesting that, in the future, perhaps I can build these presentations by just asking an AI engine to do so. I'll give it some concepts, vet it with ChatGPT, and then have my PowerPoints built for me, right? But it can also generate original imagery that doesn't require a copyright, do all sorts of things with regard to social media platforms. And then of most interest to my teenage son, it's involved in the homework market. And in fact, I asked ChatGPT to answer some of his homework questions, which it was able to do very quickly. He was doing a social studies section on Africa, and he needed to write an essay about Nigeria's post-colonialism period. And we just asked ChatGPT to do it, and it wrote this brilliant essay in a couple of seconds. And of course, I quickly deleted that because I wanted to make him do his homework the old-fashioned way, which was just go to Google and ask it, and then you've at least got to transcribe things. You can't just copy them. But every educator that's been to one of these presentations has told me they've already had their emergency meetings, and this includes at the university level as well. So there's college professors that are trying to figure out how all this is even going to work, because already all the homework is being done. Even college level students are doing research with this, and ChatGPT is not always right, but it does a dynamite job of homework assignments and writing essays and very complicated things. It's able to pull all the data together and in a matter of minutes provide an answer. So, ChatGPT came out with a new tool where it can evaluate a student's essay and tell the teacher whether it's AI or not. It gives it a score of 1 to 5. I think 5 it's probably AI, and 1 is no, it's not. So now there's other AI programs out there where you get ChatGPT to write your essay for you if you're a student, and then you take that, you copy it, you paste it into another AI engine, and it ruins some of the grammar and gets some of the syntax wrong, builds a few flaws in there in the logic, and then you have what looks like a very human essay. You send that to your teacher, and the ChatGPT engine says, "Yep, that was written by a human. You're good to go." You get your A, and off you go. So quite interesting. Now, it's turning the educational world on its head as we speak. Think about it from a business standpoint. If you're a business leader, you got a team, you don't want your team to spend days, weeks, months trying to come up with answers to questions and to be effective. Be effective right away. Be right away. Give me the answer right now. You want accurate, you want effective, you want low cost. And so teams within enterprises all over the globe are using this already as we speak to become more effective and to take some of the pressure off the labor market, because there's barely anybody left to hire, at least in the US. And now we can begin to replace some people with AI. So is that a good thing or a bad thing? We're going to replace people with AI. 50 years ago, if you were in downtown Buckhead region of Atlanta, there were tall office buildings with whole floors full of typists typing memos, because that's how businesses communicated, right? Whole floors of people. And then one day they weren't needed anymore. Desktop publishing, email, more advanced tools meant that you didn't have to have that anymore. And so, there have been these changes in the past that have happened where we thought it was going to be a real problem for employment, but AI is coming on awfully fast, and maybe it's at just the right time. If you look at this blue line on the page here, this is the unemployment rate. We see it go up, we see it go down, we see it spike briefly during the pandemic, And now it's at about the lowest level that we've ever seen. And if you've got a college degree, the unemployment rate is 2%. And there's not even folks left to come off the sidelines. The participation in the labor market is about as high as it can be. And what's really interesting to me about this chart is that the red line and the green line show you what full employment is supposed to look like based on where the economy is at. And so the blue line is below the red line, it's below the green line. And so whether you're looking at the Congressional Budget Office or the Federal Reserve's SEP projections, we're beyond full employment. The market for labor is incredibly tight. And frankly, it's holding us back. I can't believe that the blue line is below it again, but that's a sign of just how strong our economy is and why we're probably not going to be having a recession in any kind of traditional sense anytime soon, is because so many people are working. And that's inflationary, and employers are having to pay higher and higher wages to get good quality people. I mean, it's really a problem if you're running a business. And so what does this mean in the aggregate? Well, let's look at this next slide. See, the US economy grows because we have a capacity to grow. There's natural resources, there's the factories, there's energy, there's capital. You need all these things to run and grow a business, but you also need people. So if you put all those things together into some models, which the Congressional Budget Office does, you get a maximum rate of economic growth. We don't always grow at that rate, but there's a maximum level of economic output, and it moves up every year, presumably, and always has, and that's this orange line. But we're bouncing off of that maximum. We're like a balloon bouncing off the top of your ceiling. Let a helium balloon go, and it bounces. There's a little bit of up and down, but it's risen to the top and it's bouncing off of that top. That's exactly what's happening with our economic growth. We're bouncing off of this ceiling. We need the orange line to go up faster. We don't have more people. We don't have a greater ability to grow the economy. It's just, there's just scarce resources. Again, that's primarily a limitation to the lack of people. So what happens if AI makes us more effective? BIP Wealth is planning to continue growing, but maybe instead of getting to 100 people 3 or 4 years from now, we need 80 people. So we're still going to add 30 people, right? But AI begins to replace human labor. It couldn't come at a better time for investors, at a better time for the economy, because this may help to relieve the pressures of wage inflation. This may help to relieve inflationary pressures of all sorts, at the same time allowing the economy to grow significantly faster. Now, that's just the magic formula right there. You take away some inflationary pressure, but you allow the economy to grow significantly faster, and that's the best story an investor could ever hear. But we're not talking about doing this for the first time. We've been there before. You don't see a major movement upwards in that orange line in the last decade. But if you really take the long view, we've seen many times in the past where that orange line changed its slope to move dramatically upwards. Metallurgy, if you want to go way back, the steam engine, the cotton gin, the integrated circuit, all of these things have allowed worker productivity to rise dramatically. You needed far fewer workers to do the same amount of work. Now, we certainly know with the innovation community in this country, something that we like to invest in, that doesn't mean that we're going to have everybody move into 30-day work weeks anytime soon. It'll just mean that many companies can grow faster, folks can be more effective, folks are still going to work, I think, in many cases, the hours that they work, but their output's going to go way up. And output per hour worked is the measure of productivity. And so, again, if we think of this from an investor standpoint, this couldn't come at a better time. It can relieve inflation. And at some point, the stock market follows the economy. Right now, it's going, the relationship is broken. We keep getting very good economic news, and it just causes us to worry that the Federal Reserve is going to react in a way that fights the economy. And so the stock market may go down for a day or two here or there, but eventually this economic growth, this good news, results in the stock market going up, and maybe rather rapidly. And so I couldn't end a presentation without these last two slides. The first one here is the problem with the national debt. No matter what simulation tools you might have at your disposal, we just can't figure out a way to fix it. But if the economy grows faster, debt as a ratio to GDP actually falls. And so it could fix this, and then it could help to fix this problem as illustrated by the next slide as well. We're looking at the chances of having a recession. And the Federal Reserve said it was 1.1%. That's now gone up to 4.9%. They're saying it's very low, but if AI leads to greater economic output with falling inflation, then again, that probably makes the chances of a recession fall even further. So let's just go ahead and wrap things up. There's a few predictions for 2023. Maybe we're worried about AI, we're worried about the economy. Maybe if you're in mid-career, you're worried about your job. Just remember that stocks can be the very best hedge in a changing world, because equity holders have always won if they had a long-term view. So the answer here for AI from an investor standpoint might not be to buy tech stocks, it's just to own all stocks. Fixed income is normalized. Again, we can make about 4.75% investing in treasuries right now. As inflation eventually falls, hopefully that'll be higher than the rate of inflation. Watch out for having too much in any one stock. Who knows who's going to win and lose with the rollout of AI? We could see a lot of companies even going out of business while others are big winners. And lastly, private market opportunities might be as good right now as they've ever been, because even though everyone on this call got your year-end portfolio report showing that not only did we navigate the public markets well, but your private market investments did pretty darn well. Some of you even with positive returns for the entirety of your portfolio, but that's not the case everywhere. There's many venture capital firms that have really had some bad results, and they've got investments in some really good companies, but the capital's dried up. They may have poured hundreds of millions of dollars into companies to get them to where they are, but now they're short on cash. Well, you know what? We might be able to step into some of those companies through some of our investments and get a lot of equity at a very cheap price in some really interesting companies. So this is a great time to make those types of investments. It's the Warren Buffett principle. When cash becomes scarce and you've got the cash, you get to write some of the rules. So it's great that our clients didn't take the full hit from what happened in the public markets. And it's great that our clients have done so well with their private market investments. And that could give us all the resources to make potentially some of the best private market investments maybe that we've ever made this year. So it's good when other investments are in need of some cash and you're in the position to give them some of that. So just to summarize quickly, and then we'll just wrap up here, there's really just a central theme here. We can do all sorts of things through our innovation at BIP Wealth. We've got a big toolbox of tools that we're able to bring to bear to get you into all of these opportunities and make sure that you can take advantage of AI. Because we're such innovators, ourselves, we're going to be adding to the toolbox. If you've got too much in one stock, if you'd like to know that perhaps for years you can do better than you might by putting your cash at the bank, we've got new products coming out to even handle that. So when you're speaking with your personal wealth advisor, I'd only ask that you keep an open mind, because we're continually putting new tools in their toolbox. So let's just go ahead and wrap things up. Thank you very much. The main focus and the final thought here, if you hadn't caught it already, was that we are now living in the age of AI. It's not something that we're going to predict for the future. It's here now.